Hello and welcome students to my YouTube channel. In the last video lecture, I had explained you question number 8 of chapter number 6, that is retirement or death of a partner. Now in this video lecture, I am going to explain you question number 10 of your textbook. Students, while referring the video lecture, keep your textbook together so that you can refer the question together with the practical solution from the board. Let us read the question, that is question number 10, page number 268 of your textbook. Deep, Jyoti and Geeta are partners sharing profit and loss in the ratio of their capital. Balance sheet of their firm as on 31st March 2017 was as under. It means there are three partners, Deep, Jyoti and Geeta. Their profit and loss sharing ratio is directly not given it to you, but it has been told that it has been in the ratio of their capital. Now what is their capital? It is given in the balance sheet. You can see the capital account of Deep, Jyoti and Geeta, that is 1 lakh, 1,50,000 and 1 lakh. So by making the denominators equal, you can find the profit sharing ratio of Deep, Jyoti and Geeta, that would come to 2:3:2. So the old profit sharing ratio of the three partners, that would come to 2:3:2. Now referring the balance sheet, that is capital of three partners, general reserve, that is 28,000. Now this general reserve is to be distributed amongst all the three partners in their old profit and loss sharing ratio. Next, creditors and provident fund, they are liabilities. Goodwill, that is given in the old balance sheet. So first of all, that is to be distributed amongst all the three partners, including the retiring partner in their old profit and loss sharing ratio. Then afterwards, land and building, trademark, stock, debtors minus bad debt reserve and bank. Okay, now referring the adjustments. The first adjustment, that is Jyoti retired on the above date. Out of the three partners, the middle partner is retiring. There are three partners, that is Deep, Jyoti and Geeta. Out of that, the middle partner, that is Jyoti, is retiring. So the continuing partners, that would be D and G. Okay, Deep and Geeta. Now the first adjustment, that is new profit and loss sharing ratio of Deep and Geeta is to be kept at 1:1. Now the old ratio that we have found out, that is 2:3:2, and the new profit and loss sharing ratio of the remaining two partners, that is given 1:1. Goodwill of the firm valued at rupees 70,000. Now this goodwill is of the entire firm. Out of that, we have to find the share of the retiring partner. Okay. So first of all, let us start with the calculation. You can see on the board, I have written a revaluation account, prepared partners capital account, balance sheet after retirement. I have not prepared over here bank account or cash account because no any entry related to it was given in the question. That's why no need of preparing separate bank account. Second adjustment, bad debt reserve on debtors is to be reduced up to 10%. Now the bad debt reserve that has been given to you in the question, that is 6,000. Now on 40,000 is to be reduced up to 10%. So on 40,000, 10% if you count, that it would come to 4,000. So out of 6,000 to 4,000, to reach 4,000, remaining 2,000 has to be reduced. So decrease in bad debt reserve, so it would be profit for the firm, right? So you can see on the credit side of revaluation account that I have written by bad debt reserve, that is rupees 2,000. Now the next adjustment, that is third adjustment, stock is shown in the books at 25% more than its cost. Stock to be recorded at cost. Stock is shown in the books at 25% more than its cost. Now what is the cost price of the stock? That is the value given to you in the question. What is the value given of stock in the question? That is rupees 50,000. Now the valuation of stock that is given in the old balance sheet, that is at cost price. Okay, now sorry, that is at 25% more than its cost. So over here you can see I have shown the calculation. Suppose cost price is rupees 100, then 25% more on that cost price, then it would come 25 rupees on 100. So 100 plus 25, so it would come 125. Now if the value is 125, then cost price is rupees 100. So if the value is 50,000, then what would be the cost price? It has been mentioned in the adjustment that you have to value the stock in the new balance sheet at their cost price. So here we have to find the value, of stock at its cost price. So you can see 50,000 into 100 divided by 125. Doing the multiplication division, the value comes to rupees 40,000. So the new value of stock in the new balance sheet that will be showing as rupees 40,000. So instead of 50,000, the value of stock has been decreased to 40,000. So decrease is about 10,000 rupees. So that 10,000 decrease in the value of stock, so it will occur loss for the firm, and that loss is to be recorded on the debit side of revaluation account. So you can see on the debit side of revaluation account that I have written to stock, that is rupees 10,000. Again repeating the same adjustment, stock is shown in the books at 25% more than its cost. It means whatever the value has been shown in the balance sheet of stock, that is 25% more than its cost. It means it is 125 value, and we have to reach up to 100, right? So for 125 the cost price is 100, then for value 50,000 what would be its cost price? So in the new balance sheet we have to record the value of stock at its cost price. Next adjustment, that is fourth one, 60,000 is paid for trademark during current year, which is for total 6 years. Now what is the value given to you of trademark in the balance sheet? That is 60,000. Now that 60,000 is not for 1 year only, it is to be distributed amongst 6 years. So you can see 60,000 divided by 6, you will be doing that, it would come to 10,000, right? So for each year write-off amount of trademark, that would be rupees 10,000. So you can see on the debit side to trademark, because out of 60,000, 10,000 would be subtracted as for the current year. Which is the current year? That is given to you 31st March 2017. It means 1st April 2016 to 31st March 2017, that is the current year. Okay, so for the current year we have to subtract or write off the value of trademark by rupees 10,000. So out of the total value of trademark, that is 60,000, we have to subtract 10,000 as the write-off value for the current year. So the remaining balance of trademark that will be showing in the new balance sheet after retirement, that is rupees 50,000. Okay, and decrease in the value of assets, so loss will occur to the firm, and loss will be recorded on the debit side of revaluation account. So debit side we have written to trademark rupees 10,000. How this 10,000 came? 60,000 the total value of the trademark, divided into 6 years, so divide by 6. So each year for 6 years the amount to be written off, that would be rupees 10,000. Next adjustment, that is liability of provident fund is decided at rupees 35,000. Now what is the value of provident fund that is given to you? 32,000. Now it has been decided the new value of provident fund at rupees 35,000. So increase in liability by rupees 3,000. Due to increase in liability, loss will occur to the firm. It will increase the burden for the firm. So that will be recorded on the debit side of revaluation account. So you can see on the debit side of revaluation account that I have written 2 PF, that is rupees 3,000. And on the new balance sheet after the retirement, the new value will be writing, that is rupees 35,000, because now instead of 32,000 new value of provident fund we have to record, that is rupees 35,000. Then afterwards, sixth adjustment, total capital of the new firm is to be kept on the total capital of the old firm. Deep and Geeta will maintain this capital in the new profit and loss sharing ratio. Now this adjustment is very important. Total capital of the new firm is to be kept as the total capital of the old firm. Now in the old firm, whatever the capital is given to you, same capital is to be maintained after the retirement of one of the partner, that is Jyoti. It means now only 2 partners is remaining, but the total amount of capital that which was previously in the old balance sheet, same amount of capital is to be maintained in the new balance sheet also. You can see in the old balance sheet, capital account total is given to you 3,50,000. Now that capital of the old balance sheet, same is to be maintained after the retirement of the partner, that is Jyoti. So you can see the total capital I have written over here, 1,75,000, 1,75,000. This capital is to be maintained. Total of this two, it would come to 3,50,000. Now that 3,50,000 is to be distributed amongst the remaining 2 partners or the continuing partners. Which are the continuing partners? That is Deep and Geeta. In which ratio? That is the new profit and loss sharing ratio that is given to you in the question. that is 1:1. So 3,50,000 I have distributed in the ratio of 1:1. So each partner closing capital that would come to 1,75,000 and 1,75,000. Now to maintain this closing capital of the two partners, that is the continuing partners, whatever the difference comes in the partners capital account, for that the difference is to be adjusted in their current account. Okay, it has been mentioned in that adjustment, you can refer it. For this purpose, the difference is to be transferred to their current account. It means to maintain this closing capital of the two partners, continuing partners, whatever the difference is to be adjusted to their current account. So here you can see a written by current account in question mark, because this value we have found out. Okay. Now over here you can see the current account, the difference is coming on the credit side. So 92,000. So if the difference is coming on the credit side, then total of debit side is more. So whichever side total is more, then it is called that type of balance. So here it is debit balance. So on the asset side I have written that is of D and G, that is 92,000 and 92,000. It means to maintain the capital as per the old capital, whatever the difference comes, that is to be adjusted to their current account. So I hope a basic idea about the entire question has been given to you. Now after that we will be understanding the practical solution and doing the posting of all the entries in the revaluation account, partners capital account and the balance sheet. First of all, capital account of the three partners, that is 1 lakh, 1,50,000 and 1 lakh. You can see on the partners capital account, first entry that I have written, that is by balance brought down 1 lakh, 1,50,000 and 1 lakh. Then afterwards it's given to you general reserve 28,000. So general reserve that is to be distributed amongst the three partners. In which ratio? That is the old profit and loss sharing ratio. What is the old profit and loss sharing ratio? That is 2:3:2. So that I have distributed in the ratio of 2:3:2. It comes to 8,000, 12,000 and 8,000. Then afterwards creditors, no any adjustment, we already referred the adjustment. So as it is the value of creditors in the new balance sheet, that is rupees 60,000. Then afterwards provident fund, the new value already we decided, that is provident fund rupees 35,000, that is given in the adjustment, and due to increase the value of provident fund, the losses occurred to the firm, so that the simultaneous second entry of the adjustment that we have written in the debit side of revaluation account, that is 2PF, that is rupees 3,000. So always the adjustment is having two effects. So don't forget to do the posting of both the entries simultaneously whenever you are referring any of the adjustment. Then afterwards, after completion of the liability side of balance sheet, let us check the asset side. The first entry is of goodwill. Now goodwill is the old goodwill that is to be distributed amongst all the three partners, including the retiring partner, in their old profit and loss sharing ratio. So this value of 14,000, that is to be distributed in the ratio of 2:3:2. Always the old goodwill will be debited on the partner's capital account. So you can see two goodwill, that is 4,000, 6,000 and 4,000. Total that comes to 14,000. Okay. Then afterwards land and building, 2,90,000, no any adjustment is there on land and building. So as it is the value in the new balance sheet, land and building rupees 2,90,000. Then afterwards trademark, already we discussed, that is out of 60,000 right of value that came to 10,000. So that right of value we have written on the debit side of revaluation account, that is rupees 10,000, and over here the reduced value of trademark, that is rupees 50,000, because of the current year written off amount that we have deducted from it, and the remaining balance, that is for the remaining 5 years. So the new value of trademark that would be coming to 50,000, that is after subtracting 10,000 from 60,000. So if required, you can show over here, that is 60,000 minus 10,000. In the outer column you will be showing that is rupees 50,000. Then afterwards stock, that is given to you 50,000. Now stock value also we had discussed, that is already working note that I have shown it to you. That is the whatever the value that is given to you in the balance sheet, that is 125, that is 25% more than its cost. So it is given to you 50,000, but we have to show the value of stock at its cost price. So the cost price that came to rupees 40,000. So there is decrease in the value of stock. That decrease, first entry that we have written as loss on the debit side of revaluation account, that is rupees 10,000, and the second entry that is on the asset side of balance sheet, the new value that came to rupees 40,000. Then afterwards debtors, that is also we have discussed 40,000 minus the value of bad debt reserve, that would come to 4,000, because it has been told in the adjustment that is 10% BDR is to be maintained. So on 40,000, 10% it would come to 4,000. So 40,000 minus 4,000. So the new value of debtors that would be coming to 36,000. And due to decrease in the value of the bad debt reserve, profit will be earned to the firm. So it is written on the credit side of revaluation account, that is by BDR rupees 2,000. Next one, that is bank. No any entry related to bank is given in the question. So as it is the value of bank that I have written on the asset side, that is rupees 22,000. Now adjustment, any of the effect is remaining or not, that will check it out. First one, that is new profit and loss sharing ratio. Now the point is of goodwill. Goodwill firm valued at rupees 70,000. Now that is the goodwill of the entire firm. Now out of that 70,000, we have to find the share of the retiring partner. Out of total goodwill, that is rupees 70,000. From 70,000, what is the share of the retiring partner? Now the retiring partner is the middle partner, that is Jyoti. Now Jyoti is a share that would come to 3 by 7. Okay, so multiply by 3 by 7. 7 ones are 7 tens are 10,000 into 3, that would come to 30,000. Okay, so out total value of the goodwill that is given to you 70,000. Out of that 70,000, the share of goodwill of the retiring partner that came to 30,000. Now that 30,000 is to be distributed amongst the remaining continuing partners in their gaining ratio. So we have to find over here gaining ratio. How to find the gaining ratio? You are knowing it. That is new share minus old share. Now gaining share would be of only the two partners remaining, that is of D and G. D's share, that is new share, that is 1:1, so it would come to 1 by 2 minus old share, that is of 2 by 7, right? So is equal to, LCM will take as 14 over here. So 2 7s are 14 and 7 2s are 14. So 7 minus 4 upon 14. So it would come to 3 by 14. In the same way for G also the same thing would be repeated, because the new ratio is common for both, that is 1 by 2, 1 by 2. So 1 by 2 minus the old ratio is also same. You can see 2:3 3:2. So for both is also equal, that is the old ratio. So here 2 by 7 again, same calculation. So 7 minus 4 upon 14. Answer that would come to 3 by 14. It means both are sharing or having the gaining ratio is equal to 3:3. It means 1:1. So the gaining ratio is equal to the new profit and loss sharing ratio. So the total goodwill of the retiring partner that came to 30,000. Now that 30,000 is to be distributed amongst the remaining two partners in their gaining ratio, that is 1:1. So each partner will be getting rupees 15,000. Now what would be the journal entry for it? First of all, let us discuss it. Continuing partners capital account debit to retiring partners capital account credit. Now which are the continuing partners? That is D and G. So D's capital account debit, G's capital account debit 15,000, 15,000 to J's capital account credit, that is rupees 30,000, right? So we have discussed the entry. Accordingly we'll do the posting in the partners capital account. D's capital account debit, G's capital account debit. So you can see on debit side of D that I have written 15,000 and of G also I have written 15,000, and the name of the opposite party, which is the opposite party, that is to J's capital. So to J's capital that I have written in D's column 15,000 and in G's column that is rupees 15,000. Now what is the entry? D's capital account debit, G's capital account debit to J's capital account credit. So J's capital account credit I have written 15,000 and 15,000. That is of D and G. That is the name of the opposite party. So by D's capital account 15,000 and by G's capital account, that is rupees 15,000. So this was the entry of the new goodwill after the retirement of the one of its partner, that is Jyoti, and that share of the retiring partner is to be distributed amongst the continuing partners always in their gaining ratio. Okay, so this was an important point. Then afterwards bad debt reserve already we have completed, stock point also we have discussed, trademark done, liability of provident fund that also we have completed. So all the other adjustments have been completed. Now we have to maintain the capital of the continuing partners as per their old capital. Okay, so first of all we have to close the revaluation account. So you can see on the revaluation account debit side total is coming more, it is coming to 23,000. 23,000 minus 2,000, remaining would be 21,000. Now the difference comes on credit side, so it is loss for the firm. So that loss will be distributed amongst all the three partners, including the retiring partner in the ratio of 2:3:2. So that would come to 6,000, 9,000 and 6,000. So the next loss entry that would be on the partner's capital account debit side, you can see I've written to revaluation account, that is loss D. For D it is 6,000, J that is 9,000 and for G that is rupees 6,000. Now after closing the revaluation account, next account that we have to close, that is partners capital account. But before closing it, we have to keep the closing balance over here. We have to decide the closing balance. Already I told that the old capital of the three partners in the old balance sheet, that is rupees 3,50,000. Now in the new balance sheet also the same amount of capital is to be maintained between the continuing partners. So and that is to be distributed in the new profit and loss sharing ratio, that is 1:1. So 3,50,000 that I have divided in the ratio of 1:1. So it came to 1,75,000 and 1,75,000. And whatever the retiring partner difference is coming, that is always to be adjusted to his or her loan account, because now he is not acting as a partner of the firm. So whatever the difference comes in the partner's capital account of the retiring partner, we have to write the loan account to loan account. So that becomes the liability of the remaining two partners to be paid to the retiring partner. Okay, so you can see I have written the closing balance first of all. So let's close the account first of all of D, that is total coming to rupees 2 lakh. Both the side I have written 2 lakh. Difference comes on credit side, so it is debit balance, that came to 92,000. In the same way for G, that is total coming to rupees 2 lakh. Difference on the credit side, that is rupees 92,000. So I have written over here by current account, because it has been told in the last adjustment that whatever the difference comes of the partner's capital account, that is to be adjusted to their current account. So I have written by current account and question mark to show that this value I have found out. Okay, so by current account it is debit balance. So on the asset side I have written the debit balance of D and G, that is 92,000 and 92,000. Total that came to 1,84,000. Okay, now we have to find the difference of the retiring partner, that is Jyoti. In case of Jyoti, credit side total is coming more. So total of credit side, that is 1,92,000. 1,92,000 difference on debit side, that comes to 1,77,000, that I have transferred to loan account of Jyoti. So you can see that loan account we have to show as a liability, external liability. Now that becomes the liability for D and G, remaining continuing partners, to pay to the retiring partner. So J's loan account, that would come to 1,77,000. Now after closing the partner's capital account, we have to see that the balance sheet gets tallied or not. Okay, so we have already done the posting from the old balance sheet. So all the entries that we have done, that is land and building, trademark, stock, debtors, bank, current account, that is total that came to 1,84,000. On the liability side, new value of the two partners, remaining continuing two partners, that is 1,75,000, 1,75,000. Total that came to 3,50,000. Creditors value, that is 60,000. Provident fund new value, that is 35,000. J's, that is retiring partners loan, that is 1,77,000. Okay, after posting all the entries from the old balance sheet and giving the effect of all the adjustments, we have to close the balance sheet. You can see the total of both the side, that is coming equal, that is 6,22,000, 6,22,000. It means our answer is correct. When the balance sheet gets tallied, it means our answer is correct. So these type of sums I have chosen based on, because already it has been discussed that these sums are very important for the board examination, as it carries 8 marks in the board examination. So that's all for today, students. In the next video lecture, still more bigger sums will be practicing. Till then, goodbye. Keep practicing. Stay blessed.